You're 68 years old and retired with $200,000 in your 401k, and you're asking yourself the question, should I consider doing a Roth conversion? That's what we're going to discuss in our video today. Thanks for joining us. My name is John Vandergriff. I am one of the owners and the wealth planning team lead here at Blue Ridge Wealth Planners, where we help people transition effectively into retirement from the workforce, but also if they're in retirement, make sure that they have the plans that they need to enjoy that retirement for as long as they're here and as comfortable as they can enjoy it. So in that conversation is going to be looking at several factors, but one of which that we're going to focus in on today is taxes and tax planning, which is where we revolve around this conversation with a Roth account and converting monies from a 401k into a Roth position. So a couple of things we always start our videos with. If you like this content and want to share it with other people, we would encourage you to do that. Like our channel, subscribe to it, and you'll be able to get content just like this that we'll be coming out with. And make sure that you comment with any questions that you have. We'd be happy to hear feedback from you. And then the second thing is we're going to go over some details today and really dig in a little bit deeper into some things with Social Security. But make sure that you are taking your specific information and consulting with the tax professional that you work with before you make any recommendations off of this information we're going to cover, because this is a very specific situation, just like yours is. You need to make sure that you have all the information on the table before you make these moves. For us, we work hand in hand with our clients' professionals to make sure that we have all the information before we do any kind of recommendations in this category. So 68 years old, they've got $200,000 in the 401k, retired. Should they convert to a Roth? Obviously, there are a lot of factors to consider in this decision. And so, as we look at this, there are several factors that we talk to people about when we're creating a full-on retirement plan. Obviously, taxes and really income are going to be where we focus today, but obviously we've got to have some answers to how we invest, solve for healthcare, family legacy strategies. All these things need to be resolved and talked about together because they will impact one another. All five of these areas, taxes is going to be a stream that runs through all of them, and so we want to make sure that we are considering all the factors before we make certain decisions. So to dig in a little deeper to this, so this is a single person, 68 years old, $200,000 in their 401k, $100,000 between different bank and after-tax positions, and what they have at retirement, income of $2,200 a month from Social Security, no other income sources, and so with their income need being at $42,000, they need roughly $15,000 a year that they can pull off of their retirement picture here. So as we look at this, more and more people are coming to retirement with just Social Security as an income source that they have outside of their savings. And whenever we've got Social Security as the only income source and potentially a small need or a small mandatory distribution that you would have on the 401ks, if not before, by the age of 73 now, we want to make sure that we understand taking money out of 401ks and what it could do to the taxation on Social Security benefit. So most people don't know that Social Security is taxable. It is. That started in the 80s. It hasn't always been that way, which is why there's some misunderstandings here, but when we calculate Social Security taxes, the things that we have to know is we have to take half of your Social Security benefit in this equation and then any other income taxable amount and add those things together to determine how much tax you're going to owe on that Social Security benefit, or how much of it will show up as a taxable amount. So as we look at this, this is a chart for a single person, which is the situation we're looking at. There is a chart for married people. But if this combination turns out to be less than $25,000, you actually don't pay tax on Social Security. So depending on how this situation would fund its lifestyle, it is possible for them to get to less than $25,000 because, if they pulled from bank accounts, didn't touch their 401k, they could show up less than that. But we're going to show you an example here where that probably won't be the case. They may need to withdraw from their 401k to meet their lifestyle needs. So if we add some things together and that number is between $25,000 and $34,000, 50% of your Social Security is taxed, and then if you go above $34,000, 85%, which is the maximum tax, or the maximum of your Social Security that will be taxable, shows up on your tax form. So again, we want to make sure that we understand this, and we're going to dig into the specifics of this example in just a second, but we've got to know that the decisions that we're making, any Roth conversions that we do, can have an impact today on how much Social Security tax we pay, and we just have to weigh the total picture here to see what gives you the best situation. So as we've zoomed into our plan for everything board here, focusing on the income, as we said, $42,000 a year is what this particular person needs. It's $3,500 a month. $26,000 of that is provided by Social Security, so $15,000 and change is what they need from their savings. So as we look at this, going over to their annual income need, after they satisfy what their lifestyle is, they would be in the top bracket of 12% as far as their taxable income goes, if they pulled it all from taxable sources. Pre-tax monies, as we said, $200,000, after tax $100,000, and then no current tax-free accounts with either Roth positions or properly structured life insurance, which offer tax-free benefits. So as we look at this, again, with Roth conversions, any money that we move out is going to make that situation more taxable. You know, just depending on how much it goes through the brackets, but also how that mixes together with Social Security. So we'll look at that in just a second. But again, big picture things that we need to consider with a Roth IRA. The Roth needs to be open and in place for 5 years before you have completely tax-free distributions on that original amount. And then if you're over 59 and a half, during that 5 years, the principal that you convert is available to you for that 5-year period, but any growth would be taxable. So we need to understand that, you know, so that we don't over contribute into this and maybe think the entire thing's taxable, and then we find out that that's not the case. So as we look at this example for Social Security, I wanted to do these as kind of a side-by-side comparison just so that you can see the difference here, because like we said, the equation here is half of your Social Security benefit and then any other income taxable source. So as we said, half of their Social Security is $13,200. The income that they would need, and we're assuming that they pull it from their 401k, that way it does show up taxable, would be $15,600. So if that was together, $28,800 would be their income for this equation, and because it made Social Security 50% taxable, that also is their taxable income for that particular year. So as we said, if Social Security was fully taxable, their income tax would be $42,000, but because they didn't go outside of the 50% threshold, they're paying only 50% tax on Social Security. Their taxable income is just under $30,000. So as we look at this, let's say we do a small Roth conversion and we just add it to this picture here of $5,000. You notice that those add together and get to $33,800, which is at the very top of that 50% bracket. If they went into the next one, then it would cause this Social Security amount to jump up to 85% taxable. That would increase their taxable income, but this is kind of getting to the very end of where their taxable income would be in that 50% bracket for their Social Security. So as we look at it, in this particular situation, if we wanted to keep Social Security taxed the same way for round number sake, you could do about a $5,000 conversion, but if you didn't want to mess up your current Social Security situation, that may be kind of the limit, especially if you're not sure about interest payments or bank interest, things like that. That would probably be the top of that recommendation. So if we did $6,000 of a conversion, we jumped into 34, then that would make, as we said, 85% taxable on Social Security, and then your overall taxable income would show up a lot higher. So we want to look at that and then factor in, you know, as we look at these situations, we notice that both, if we take our income from the 401k, we're in a position where our top tax rate for conversion would be 10%, or really going into the 12% bracket, we would exceed 10. So we would have 12% that would be owed on any converted dollar. So if we did the $5,000 conversion, it would be at 12%. But we have to compare that to where those brackets could be later. So So 2017, the reason that I bring this up is that is also, if no changes are made, where the tax code will revert back to in the year 2026. And if that's the case, what is now the 12% bracket would become the 15% bracket, which would make any monies coming out of the 401k more taxable, which again is what we don't want. We want to try to have the most efficient picture. And again, as we look at this, the particular example here is taking out at a mix of 10 and 12%, and even if they get to a point where they're taking that income out from another place, by the time they reach their required minimum distribution age of 73, they're going to be forced to take out roughly 4% of whatever that account is worth at that particular time and pay taxes on it at that rate. And so, as we look at it, it's going to be a situation where, depending on how long this particular person lives, they may actually be forced to take out more than their lifestyle needs necessitate from their 401k and be forced to pay, if taxes go to this example, at 15%. And then the reason I bring up this last one, 1981 is the last time that tax brackets were significantly higher. As we look at the top tax bracket here was 70% compared to the top tax bracket today, which is 37%. So as we look at this, the reason we wanted to bring this up is in this particular situation, and again, depending on which level we went to, you would be at either a top bracket of 19%, or with the 5,000 conversion added in, you would go into 21, which is noticeably higher, not quite double where those brackets are today, but by percentage, a substantially higher percentage going to the government of this income than it would be today. So as we look at this, when we have to consider Roth conversions, we do want to make sure that we understand what really we've got to measure in this particular example. And there are some factors that we do not know. So in this, we do not know where taxes will be for sure in the future, but we've got some opinions that I believe taxes will probably increase over time. And so if that is the case, then we've got to look at the example of, does a movement of money from the 401k to an account like a Roth IRA make sense today, or should we not do it at all? So that's what we're going to look at with a very simple example here. So let's say, round number sake, you got $100,000 that you're looking to convert. What we've got to examine is, what will the taxes be on that $100,000 if we leave it alone and pay it later, versus what would those taxes be if we made that conversion? So again, as we leave it in the 401k, no taxes are owed now, so it stays at a $100,000 account balance. The Roth, obviously it depends on the tax bracket at that particular time, but if we just round it off at 20%, and we pay those taxes out of this 100, which makes it a fair comparison point, then $80,000 what we start the Roth with, $100,000. And so most advisors that you talk to, when you bring up the topic of Roth conversions, they may show you an example like this and stop right here and say, this is why this is not a good decision for you, because in this scenario you've got $100,000, in this scenario you've got $80,000. If the market goes up, you're going to make more money over here than you will in the $80,000 Roth account, which from a numbers and a math standpoint is true. 10% of this is 10,000, 10% of this is 8. But we're not looking at even buckets of money, because this one is a fully taxable 10 versus a tax-free 8, as long as it's in place for 5 years. So as we look at this, we've got to continue the example, and again, keeping all the factors equal from a growth perspective, time perspective. That way we take care of inflation, time value money, all those things that people will try to throw into this equation as reasons not to do it. Again, I look at this and we've got to make sure that we are evaluating the right factors in the decision-making process. So let's assume they both invest in the same thing. Both of those things double in value. That means the 401k is now worth $200, the Roth is worth $160, and now we're in a point where we need to draw this money out in some capacity. In this example, we're just going to look at it as if it's done in a lump sum. So as we look at this, if we pull from the Roth account, you've got $160,000 that would be owed, or not owed, but available, because the Roth has grown tax-free this whole time. the 401k, it depends on what the balance is and what your income is at the time and what tax brackets are and how this affects that. So if we got 20% that's owed there, what you will notice is that in both of these situations, the bottom line number is exactly the same. So as we look at this 160, if you had it in the 401k, 160 if you had it in the Roth, doesn't matter if it grew taxable or tax-free, if the tax brackets are the same, you get the same end result. Now, the reason that people will typically recommend not doing Roth positions is they have a strong opinion that they feel taxes will not be higher later for you, they will be lower. You know, again, the traditional school thought is, oh, I'm going to have less income in retirement than more income, so let's defer all my taxes to when it's less, because less income would translate to less taxes. The problem is no one has ever promised you that, but if that assumption was correct and you went down to a 10% bracket, you would actually have more money in the bucket that was growing fully taxable than you would in the Roth account that's been growing tax-free the entire time, because the exit point bracket is lower than the entry point bracket up here. So again, it matters when can I pay the lowest percentage of tax. Now again, based on what's happening today, we've got to throw some current events into here to show what in a lot of the cases that we talk to, I think is a more realistic picture. I think taxes have a strong chance of going up because of the overspending in Washington, the huge amount of debt that our government is carrying. That's going to translate to, at some point, a tax increase that we are going to feel, especially if we have money that's still income taxable in the way that it grows and the way that it's withdrawn. And so as we look at this 401k, it is 100% exposed to legislation that would increase taxes. And if that were to happen and our taxes went from 20% to 30%, well, that means this $200,000 loses 30% of its value when it comes out, to the tune where you've now got $140,000 versus $160,000 in the Roth, because you already paid the tax man when you entered this account. So as we look at this, the whole game that we're trying to figure out without the end pieces, which makes this a little bit more of a challenge, is when can you individually pay the least amount of taxes? That's what we're after. And so as we look at this, we've got to weigh into some different things to consider, because as we look at this, starting distribution today, as we said, would be 12% on any conversions that happen. As we look in the future, it would be at 15% if we went back to the 2017, but as we said, is really the 2026 tax brackets. So again, they refer back to the 2017 code. And then 1981, if that were to repeat itself, would be 19%. But I think reality is probably somewhere between these two. You know, if taxes need to go up to take care of the huge amount of debt, again, it's not just going to be little increases, it's going to be larger increases. And typically those larger increases will get bigger the higher up the income tax brackets you go. So as we look at this particular situation, we don't want to go crazy aggressive for a very long period of time, because we don't have a huge amount of money in the 401k, but also we don't want to just completely jack up their Social Security for no reason. And so as we look at this though, 12% I feel like historically is a pretty low tax bracket to pay on, especially if we get into a picture of higher taxes later when the client, or the example here, is forced to take out money for the rest of their life. If they do a really good job investing in their 401k, they will be in a position where they probably have a higher overall tax on that money than 12%. So for this particular situation, he has a little over $20,000 of clearance to stay in the 12% bracket. I would probably recommend doing that based on the factors that we look at. That would lower his 401k taxable balance by a little over 10% and give him more money that's now growing tax-free, and also gives him some tax diversification, because now he would have money in all three of those buckets, especially if he repeated this process while we continued to have 12% as his top tax bracket. So as we look at this, sometimes with Roth conversions, even if we do a little bit, sometimes that little bit can be a very important little bit, because now we start to get some different tax benefits from this money than we would if we just left it alone and hoped for the best. So as we look at this could be the recommendation for what we're looking at. It does have some drawbacks because it would make Social Security taxable for any of the years that we went, as we said in that example, over that $5,000 of conversion. But we've got to weigh this compared to where we think things will be later and make the best decision that we can. So if you've not been able to benefit from a conversation like this, we would be happy to share this information with you based on your individual situation. These aren't cookie cutter recommendations. You're going to see a link where you can click to set an appointment with somebody on our team, where we can look at your situation, see where we think your income needs to be in the future to accomplish the things you're wanting to do in retirement. And also what type of strategies or movements make sense as a result of that. Because again, the opportunity that we have today may not be around for very long. As we said, if things progress the way we think, it will expire after 2025. Obviously, they could continue that or cancel it earlier. So we've got to make the best decisions that we can with the opportunities we have today, and not wish that we had some opportunities later, because nobody wants to have a regret when it comes to tax decisions. So make sure that you take advantage of that. We're happy to talk to you, see how we can help. Again, I hope you enjoyed the information we talked about today. If you would, share this with someone else, like or comment to this video, and let us know what feedback you have, and we'd be happy to interact with you there. But that's all we have for today. Check back with us in more of our content, and we look forward to helping you hopefully make some good tax decisions in the future.